This week's was called A New Dawn, and that was basically because we're looking at a new dawn in English housing, in my opinion, on the back of the English Housing Survey. So, the English Housing Survey consistently reveals a tale of two Englands. For some, home is a safe haven and a substantial asset. For millions of others in the private rental and social rented sectors, it's a story of spiralling costs, persistent disrepair, and a profound lack of security. And that came from an analysis of what it says effectively in the English Housing Survey. So is that what I think? Partially, a little bit, maybe. There's an element of truth to it, obviously, in terms of spiralling costs. But of course, there is if you've got a mortgage at the moment and your interest rate, your mortgage payments probably went up 50, 60, 70% in the last few years if you renewed your mortgage. So we're all suffering with that, the squeeze from the normalisation of the interest rate. Persistent disrepair, well, there's plenty of evidence of that, so can't really argue with that. Profound lack of security, not sure that's been addressed by the Renters' Rights Bill, but I guess we're going to find out. But that was indeed a quote from myself. That's about the third time I've ever done that because I couldn't really find anything I was happy with this week. But ultimately, the reason why I say that is because that's what the politicians are going to hear from the English Housing Survey. And it's such an important document. It is really the Bible as far as politics is concerned in terms of what they're thinking about doing to the private rental and social rental sectors in future, even if it isn't the reality of the deep dive. But before we tuck into the meat, as the calendar creeps towards a new year, it's a natural time for us all to pause and tackle the biggest challenges that keep SME property businesses from achieving true sustainable growth. For most, this boils down to two core areas: laying a bulletproof strategic plan for the next 12 months and finally cracking the code on financial measurement and accountability. If you've ever felt lost in a sea of bookkeeping data or your productivity methods are falling short, it's time to switch from doing to leading and truly understand how your assets are performing. So book in on the next property business workshop with myself, Adam Lawrence and Rod Turner. Thursday the 22nd of January, Central London. Link in the show notes. It's also at tinyurl.com/PBWNINE. And I just wanted to say a thank you as well for all the feedback I've received in the past week, in person, via message and email. I did ask for feedback last week, so I changed up the format of this slightly. And I'm always so pleased to hear from people who do read or listen week in, week out, or every other supplement, as some people are brave enough to confess to me that they do, or whatever. I understand not everyone's got the time every week, don't worry. I'm surprised I have the time every week, to be honest with you, but I do make it a number one commitment in everything that I do. So I've placed an obligation on myself ultimately to produce this piece of work once a week, and I've been a long time thinking it's getting a bit too long. It's getting a bit unwieldy. I don't want that, of course. I value my time. I value your time. I do still want to ensure that I get my messages across, of course, but I don't want to lose sight of clarity. And so I want to make sure you get value and I get value as well. So with that in mind, I've played around again with a few refinements, particularly in trying to be concise. So I'd love to know what you think. Propenomix will kick us off once more. The UK was directly involved in the EPD, the US-UK Economic Prosperity Deal. What was on the table? Well, they wanted us to pay more for new drugs. They're saying we weren't paying enough. The US spends more than anyone else on research and development for drugs. And in the eyes of Donald, we weren't paying enough to his wonderful companies. But in fairness, maybe he's got a point. So now we will. It keeps them free of tariffs, which is very important. The NHS budget has to go up on the back of it. But it is a relatively small fraction of the NHS budget, actually. That still makes it billions of pounds. But it's around between the sort of 10% and 12% mark as a general rule. And of course, the drugs will still need to deliver measurable and worthwhile benefits, which will be handled by the least nice organisation of them all, which is called NICE, the National Institute for Clinical Excellence. A tough job being involved in NICE, that's for sure. Mr. T also oversaw the release of a national strategy document, which I'm sure you will have seen in the news, referring to Europe's civilizational erasure. No, not a band from the 1980s. That's to do with migration and integration. And it often strikes me that European nations, generally thought of as pretty liberal, are actually pretty strong on cultural changes and religious ground shifts that they do not like. However, the report seems to pin what we already knew to the mast. The US has plenty of time for the nationalist further right parties that have captivated a lot of attention and votes in recent years. What did we do in the UK? Well, we reminded the US that we were independent and we set our own foreign policy and said in a very British way, we don't need your advice, thank you very much. What's looming in the background? More tariffs, further ongoing negotiations on that front. Next up, UK real-time property market back on the slate. Chris Watkin is our man in Amsterdam as always. a stripped back summary of his article this week. So, market overview and listings. A massive surge in £1 million plus listings in inner London following the recent budget. That is enough, actually, at that sort of level to move the needle on the average price of what's been listed. So the national average listing price went up by over 20% in 1 week to 452k. However, I've commented over recent weeks, and so has Chris, that this has been suppressed actually by the fact that so little stock over about 500 grand before the budget was being listed. So that sort of certainty of the mansion tax, even if it wasn't necessarily particularly popular, gave us a bit of a way forward there. So average price for sales agreed remains at 350 grand. So this week's gap, 29.3%. Unusual to the other side. We had this 6.7% last week, which was unusual to the downside. Now 29.3. Interestingly, they average out those 2 weeks at about 16.5%, and the long-term gap between asking prices and sales agreed prices about 16.5%. So there we go. Never read too much into 1 week or 1 month, as I say all the time. New listings on the market slowed down to 22,700, consistent with seasonal expectations. Still 0.5% of 2024 in terms of listings, but only 0.5%. We were 6 or 7% ahead of 2024's listings at certain points in this year. Things have calmed down, and last year things were going gangbusters with listings because the market had just started to wake up. We just had that first clip in the interest rates in August, and more clips were coming, and we were very happy to see those. So that's why we had a second clip in November as well. So that also buoyed people to list their houses and try and move on, try and get rid of them if they were investment stock they wanted to get rid of. Try and just move up the ladder because they delayed that in 2023 because the market was so anemic. Sales performance, well, gross sales volume remaining resilient, 20,300 homes sold subject. Year-to-date gross sales, 1.203 million, good number. 3% ahead of 2024, nearly 12% ahead of the pre-pandemic average. Net sales, that's the sales minus the fall-throughs, are also positive, 2.6% ahead of 2024, 914,000 year-to-date. With still a couple of months left, thought it might be a little bit higher, to be honest, in terms of net sales, but let's see. Reductions and stock, well, price reductions dropped to 13,200. Agents do seem to forget to try as hard at reductions in November, it seems. 8.8% of homes seeing a price cut in November, significantly lower than October's 12.8, and we had a 13.4% average for the year, so a big drop really. Fall through rates remaining stable at about 25%, just ahead of that long-term average 24.2. Total stock levels on December the 1st, I like to watch this one because it talks about supply specifically. 678,000, almost exactly the same as December the 1st, 2024, interesting enough. The sales pipeline is 2.2% bigger than it was then though. That 678 is the first time under the 700,000 mark for many months, and you could say stock levels on the market are still creeping fairly quickly back towards a normal level of stock on the market. Are smaller investors, is it offering them a good way? Are they now into their great disposal phase, which, as I've commented before, is not necessarily seeing a lot less in terms of rental stock because it is larger companies, corporates and institutions heading our way in terms of picking these disposals up. So rentals are becoming rentals. Although I will say, from my own experience of ex-rentals we've sold this year, and we do sell quite a few every year now. We've got a target of trying to sell 50 next year. Our target on the acquisition side is to try and buy 150. So it gives you an idea. We're still trying to grow the portfolio, but we will dispose of about 50. Gives us a good idea of what's on the market, and there are asset management reasons why we want to get rid of various properties. It's just good timing sometimes, apart from anything else. For that specific property, it's like effectively an idiosyncratic risk, if you like, that we're trying to get rid of. But are we into that great disposal phase? Are we well into it? 50%, 70%, 90%? We don't really know. We'll have to keep an eye on it in the new year, and also on landlord sentiment as we come up to the implementation of the Renters' Rights Act, of course, on the 1st of May 26. But overall, the market's showing steady activity ahead of 2024 levels. Yes, seasonal slowdowns. Yes, the budget has messed with these figures, which it never normally does this late in November, early December, but that's where things have been. So we've really come right back to a 2024 in the end with only a few weeks to go. Now, Chris always gets this weekly shout out from me. His stats are brilliant. Drop him a like, a subscribe, a follow at Christopher Watkin on YouTube. His articles on the Property Industry Eye website, show him some love. And if you ever want any help with becoming more of an authority in your local area on property, that ultimately is Chris's core business. So give him a shout. Okay, what about this week's macro stasis then? Well, Nationwide and Halifax both produced their house price indices. Bank of England Money and Credit Report gets some airtime. I also put the PMIs in, of course, alongside Homes England, who produced their house building stats. Why do those two go together? Well, because of the construction PMI this month, and you will see it's a very bad number. I'm not going to lie. And our final round of macro, well, we always have the gilts and the swaps, don't we? So Nationwide are always first out the trap, so they get to go first in the supplement as well. Regarding growth and prices, 1.8% annual price growth in November. That slowed from 2.4 for October. Prices up 0.3% per month, month on month, after adjusting for seasonal effects. So the budget didn't have that much impact, it seems. They have the average UK house price at just under £273,000, 272,998. They talk of market resilience, and they have done many times this year. Their chief economist, Robert Gardner, describing the market as fairly stable. Mortgage approval levels recovering to pre-pandemic norms. Resilience despite mortgage rates remaining pretty much double what they were before COVID-19. And house prices also hovering near record highs. But that's only nominal, of course, so don't fall into that nominal trap. 2022 money is worth a lot more than 2025 money, I'm afraid to say. But this stability persists even amidst subdued consumer confidence and a softening labour market. Post-inflation adjustment continues, and I sit here wondering sometimes how long until the real bottom. Will that just be when inflation is truly under control, or will 2026 be the year when we outstrip 3% nominal price growth for the first time in several years? Because it feels like 3% is about our number in terms of where inflation will be next year. And in fact, the decision makers panel are expecting 3.4% inflation on average in 2026. So their expectations are high, and they've been anchored to be high ultimately. What about policy impact? Well, Robert Gardner suggests that recent budget changes will have minimal immediate impact on the sales market. Similar to what I've been saying really since the budget. This high value council tax surcharge, HVCTS, actually the mansion tax as it's colloquially now been called, it's coming in 2028, and it affects less than 1% of the properties in England. However, increased taxes on property income could dampen the supply of rental homes, potentially sustaining that upward pressure on rents, which are already at a historical high. Difficult to say, isn't it? Because ultimately that 2% is going to get you one way or another. If you want to save, if you're investing it, you're saving it within a property. If you're saving it outside of an ISA, but within a taxable account, those rates have gone up 2% as well. Your dividends have gone up 2%. If you've got stocks and shares as an alternative, But I'm pretty pleased to see this assessment from Robert Gardner, a lot better than people claiming 10% off all property prices in the UK because of the mansion tax. A fundamental misunderstanding there. Really, they think the market is working top down, which it absolutely doesn't. There isn't a trickling down from the mansion tax side of things. The market in the UK works bottom up. People start at the lower end of the ladder and they climb. And let's face it, fewer than 1% of them, quite clearly, ever make it into a house that's worth over £2 million. So it's not the market. It's a completely disjointed market in my experience of prime and super prime, realistically. Anyway, what about the outlook from Nationwide? Well, affordability expected to improve modestly. Income growth outpaces house price rises. If bank rate is lowered in coming quarters, borrowing costs might moderate further. And this, combined with household debt to income ratios being their lowest in 2 decades, is expected to support buyer demand moving forwards. Lowest in 2 decades. I've heard that before somewhere. If only someone had identified this first of all back in July 2023 and then had been talking about it for the last 2.5 years in a relatively easy to digest Sunday morning regular periodical, free at the point of consumption. Oh yeah, they have been, because I have been. But well done, Robert, you've caught up now, and I've been using your own figures against you, amusingly enough, while I've done that. But anyway, on to the Halifax. House price index from Halifax for November 2025. They're emphasising marked stability in the marketplace. House prices remaining broadly flat for the month, according to them. 0.0% change, up £139. Annual rate of growth, though, according to Halifax, 0.7%, down from 1.9% in October. Weakest annual growth rate since March 2024. Despite the slowdown, the average property price stands at a record high of 299,892, hovering just below that psychological 300k barrier. So what about the context? Well, Amanda Bryden, who's the head of mortgages at Halifax, described 2025 as one of the most stable years of the housing market over the last decade. Now, you wouldn't necessarily have expected that, but then you might have done in the context of everything since 2020. But bear in mind, we have also absorbed a stamp duty reintroduction, for example. That sharp dip in annual growth figures is largely attributed to base effects, right? Comparing current prices against a period of strong growth a year ago rather than a dramatic recent turn down. The market has shown resilience in the face of political uncertainty surrounding the recent autumn budget. Not said for the first time by Halifax there, not said for the first time by all of us, let's face it. But if you think, 2016 we had the referendum, 2019 was particularly flat, 17 and 18 kind of bumbled along, but there weren't a huge amount of transactions going on, as we see on a week-on-week basis when we look at Chris Watkins' figures. How about the regional divide and affordability in general? Well, the north-south persists, with advantage still to the north. Northern Ireland remains the strongest performer, annual growth of 8.9, Scotland at 3.7, London down 1% according to Halifax, and the South East down 0.3. Like the ONS and the overall regional reports in the RICS reports, for example, London is falling, officially in nominal terms. On a positive note for aspiring homeowners, affordability is improving. With income growth outpacing house price rises, affordability is now at its strongest level since late 2015, and mortgage costs as a share of income are at their lowest in 3 years. Looking ahead, Halifax forecasts gradual price growth continuing into 2026 as interest rates are expected to moderate further. When you think this includes the complete normalisation in interest rates, which are still on their way south in terms of expectations, this is great news for buyers and the market in general, and likewise great news for vendors, including smaller investors, who might be disposing and hoping to sell to first-time buyers, which is usually a far better prospect than selling to investors in my experience. Onwards we go with the summary of the Bank of England's Money and Credit Report for October 2025, which was released on December the 1st. So lending to individuals, mortgages and housing, this is the juicy bit. A noticeable cooling in mortgage activity, the bank says, but ultimately that was more by quantum. I mean, the net borrowing of mortgage debt by individuals 4.3 billion, down from 5.2 in September's, but mirrored by forward-looking indicators, net mortgage approvals for house purchases down 600 to 65,000, so down less than 1%. Don't think we need to be too concerned. Significant decline in remortgaging activity, however, falling by 3,600 back to 33,100 approvals. That's the lowest figure since February this year, but maintaining that 65k is still indicative of a very stable market though, and a 1% adjustment is infinitesimal really, especially with the backdrop of the budget. Despite the slowdown in volume, the cost of new borrowing improves slightly for homeowners. The effective interest rate on newly drawn mortgages dipped to 4.17. That continues the downward trend we've been observing for many months now. But the rate of on outstanding debt, the outstanding stock of mortgages, was static at 3.89. 26 basis points is now the difference between existing and new, and the aggregate effect on the market of the interest rate normalisation is all but complete. And in 2026, those figures really should converge to the new normal, I hope. What about consumer credit? Well, consumer appetite for unsecured debt also waned. Consumer credit net borrowing decreased to 1.1 billion. That's 600 million credit card borrowing, 500 million in other forms of credit, car finance, personal loans. Still net, remember, so that is still increasing. Total growth rate for consumer credit 7.2%, obviously not sustainable. Credit card borrowing 10.9%, but of course this could be due to the fact that a lot of the limits have been lifted in terms of balance transfers and things like that. They died right back to like 12%, 12 months interest free, and now they're back to like 35 months interest free and things like that. And that will be a big deal because 40% of all credit card debt is on a 0% credit card in the UK. It's not like it's a secret thing or something that only a few of us do. We're at it in a very large way, getting that interest free credit. Growth in other forms of credit slowed to 5.5%. As I say, not sustainable numbers, although 5.5 is not loads ahead of wage growth, but then you'd have to look at net wage growth after tax, of course. Nothing to get worried about just yet, but we're keeping our eyes on it. This is credit repair post-COVID really still happening. And that's still, savings repair is still happening, credit repair is still happening. It is what it is. What about lending to businesses? Significant retrenchment in the corporate sector. 4.8 billion from PNFCs repaid in October. Private non-financial corporations, I think not banks, paid back nearly 5 billion quid net in October. The highest net repayments for 2 years since October 23. Substantial amount of bank loans and bond redemptions aside from anything else. Large businesses focused on paying down debt. SMEs remained pretty flat in terms of what they did. They net borrowed 100 million quid. Why were they paying it back, the big ones? Well, because they weren't investing it, were they? They were busy waiting for the budget, and while they had it sloshing around, instead they decided to pay some debts down, because that's what the CFO and that's what the finance department ultimately do. Are we going to deploy that money? No, let's crack on. Right. Money supply and deposits. Households focused on savings, depositing an additional 6.8 billion into banks and business in banks and building societies. I apologise. There was a clear preference for liquidity and tax efficiency, with 5.5 billion flowing into interest-bearing sight deposits and 4.2 billion into ISAs. So net flow of sterling money slowed to 8.5 billion, down from 14.2 billion in September, reflecting a broader period of consolidation across the UK economy. Bit of fear of ISA clipping that was going on before the budget. Would the limit go down to 5,000, 10,000, 12,000? What would happen? Obviously, what ended up happening was 12,000, and then keeping the 8,000 there for people to ultimately invest in shares if they wanted to. So you still got your 20 grand allowance. You just can't use it on cash all the way through, unless you're over 65, in which case you still can. And they're the only people who've got any money anyway. But we'll talk about that bit later on when we get to the English Housing Survey. So, money supply and deposits, lots of focus on savings. I watched the money supply M4, the measurement. There are many different measurements for the money supply, but M4 actually shrank by 0.2% month on month. And that's helpful to clip inflationary wings, because the figure the month before that I highlighted at the time was plus 0.6%, which is highly inflationary. So that helps out a bit. What about those November PMIs then? It was a mixed bag, signalling weak growth, but significant disinflationary trends that policymakers cannot afford to ignore, according to the S&P Global commentary. The overall UK private sector saw output growth weaken to a marginal expansion. Composite output index 51.2, down from 52.2 for October. Total new work declined fractionally, but contributed to the steepest overall decline in employment since February. Now, the flash number was only 50.5, so the 51.2 was considerably better than we first feared, but it's not a strong growth number. Nor could it have been in the actual budget month when there was so much speculation. A print above 50 was the best we're going to get. Services sector, which of course is our primary economic engine, slowed significantly. Business activity index eased to 51.3, signalling a marginal expansion that was much softer than the pre-pandemic average. The real kicker, we saw a renewed downturn in new orders, the first recorded since July. The weakening demand, coupled with fragile client confidence and delayed investment decisions due to budget uncertainty, contributed to the fastest fall in employment since February. Perhaps the most critical takeaway for the Bank of England is that while input costs, largely salary payments, accelerated, prices charged inflation across services hit its lowest point since January 2021, suggesting intense competition is eroding margins. Good? Okay for the consumer, tough for the firm. Meanwhile, construction is deep in the red. November data revealed a sharp retrenchment, with the total activity index 39.4. That is a flashing red warning signals print, folks. The steepest downturn in output for 5.5 years. And you know what happened 5.5 years ago. So activity fell across all three subsectors: housing, commercial and civils, all registering their sharpest fall since May 2020. New order intakes declined at a pace not seen since early 2009, excluding the pandemic, and consequently staffing cuts were the most marked since August 2020. Business optimism was also at its lowest point since December 2022, all fueled by pervasive worry about long-term UK economic prospects and delayed client investment ahead of the budget. Now, hopefully that's the last time this year I'm going to mention budget pessimism, I promise. But let's face it, the ruling party do need to do a better job. Was there a glimmer of sequential improvement? Well, there was a little one in manufacturing, edged back into growth territory for the first time in over a year. PMI 50.2, which was also the flash number. Production rose for the second consecutive month, supported by improved domestic demand, although new export business remains in contraction. However, the headline news here is price action. Rising competitive pressures and weak sales pipelines led to factory gate selling prices being cut for the first time in over 2 years. This combination of soft performance and subsiding price pressures signals a clear shift in the policy debate away from inflation fears and squarely onto the need to support economic growth. The takeaway is simple: uncertainty, especially around policy, once again proved to be highly costly. As so often, our services carried us, but manufacturing is not dragging us back. Construction numbers are really worrying though. We do need to hope it was just a pre-budget freeze and it will all be all right on the night. Let's see. Did Homes England agree with that? Well, I've just talked about November's PMIs because they are very much up to the minute, whereas the Homes England report that was released very recently was a summary of what happened between April and September. So we're not quite comparing apples and apples. But here's what they said. Well, you get details of housing supply delivered through programmes managed by Homes England across England, excluding London, apart from specific programmes they administer on behalf of the Greater London Authority for that 6-month period, 1st of April to 30th of September. It focuses on housing starts on site and housing completions, providing a snapshot of the government's progress in delivering both private market and affordable housing. Housing starts then, 15,581 in 6 months from Homes England. Of these, 11,474 were designated as affordable, 74% of the total starts. That's 12% down on the same period in 2024. Significant portion of these affordable starts, 8,938, had their tenure listed as to be confirmed, which is a small increase of 1% to the prior year. But the confirmed tenures are the ones that saw the substantial declines. Social rent starts dropped by 38% to 1,248 units. Affordable rent starts fell by 24% to 826 units. Intermediate affordable housing schemes, including shared ownership and right to buy, had the sharpest decline, decreasing by 68% to just 462 units. And the vast majority of these starts, 94%, were being delivered under the Affordable Homes Programme, the AHP, 2021 to 2026. In terms of finished housing, 13,500 units were completed during the 6-month window, and affordable accounted for 10,309 of those, 76% of the total. A 3% decrease in affordable compared to the previous year. Unlike starts, the completion figures show mixed performance across different tenures. While intermediate affordable housing completions fell by 8% to 4,654, and affordable rent completions dropped by 5% to 3,316 units, social rent completions actually saw a positive trend, increasing by 15% to 2,339 units. So what about the context of the programme? The data highlights the transition between funding cycles, shared ownership and affordable homes programme, that was the SOAHP, trips off the tongue, doesn't it, 2016 to 2021, which closed to new business in March 2024, is still winding down, but still contributed 25% of the completions. That newer programme, 21 to 26, is now the primary driver of supply, responsible for 70% of completions and 94% of starts. So overall, things are going backwards, not forwards, in terms of the tenures that were supposedly so very important to this government. 12% fewer affordable housing starts, sinking like a stone. 38% fewer for social rent. Homes England blamed base effects and the changeover from one funding programme to another, and simply claimed these were back to business as usual figures because last year there'd been a surge. Did they point out that last year was the anomaly when they talked about it last year? I'll let you guess on that one. I'm not so sure that they did. Did they manage expectations and head those off at the pass? No, they did not. What about the gilts and swaps then? The number watch. 5-year gilt yields opened the week at 3.93, closed at 3.942. So if you are going to have an up week on the yields, 1.2 basis points is acceptable. Thursday's close at 3.891% was preferred, translating to a swap of 3.574. So 31.7 basis point discount. That discount is narrowing slightly. We've observed a 35 to 36 point discount for what feels like an awfully long time now, but we're down to 31.7. So let's just keep an eye on whether that's an ongoing trend, and we won't see as much cut in the swaps as we do in the broader gilt rates, which wouldn't surprise me. 1 month ago, we were at 3.61 on the swap. 1 year ago, we were at 3.814 on the 5-year swap. Now, the 2 years even better. 3.453 on the swap compared to 3.536 a month ago and 4.089 a whole year ago. So 2-year mortgages look a lot cheaper. 5-year mortgages look a little bit cheaper, basically. What about the 30-year gilt? Well, that opened at 5.241 and it closed down at 5.197. The bond markets continue to digest the budget, and very little of the macro news really changed too much from a yield perspective. The longs are calming down further, and they tested 5.15 on Thursday and Friday last week, but ultimately they rebounded. But still, 5 basis points off the longs means a slightly shallower yield curve, and seeing the 30s below 5% would make quite a lot of the people happier about the market's view of the long-term economic stability of the UK. So the deep dive. I had no choice, as so often happens this week. The release of this first wave of the English Housing Survey for 2024-25. Remember, we talk about the fiscal year here, so it ends March 25. It was out. It is so important from a policy making perspective that regardless of the accuracy of surveys or other concerns, we have to go deep. So in we go. The 30-year mortgage is the new normal, and the elderly now own England outright. So the English housing market, as delineated in the 24-25 English Housing Survey, shows you this structurally dichotomous profile, characterised by an intensified concentration of demographic capital in the older cohorts and an increased reliance on long-duration leverage among new market entrants. While the overall aggregate proportion of owner-occupiers has stabilised, having declined after the financial crisis, the internal composition of this tenure demonstrates a profound shift that necessitates a rigorous longitudinal analysis, extending back over 2 decades to put into context the current inflection point. That fundamental macro trend confirms that owner occupation remains the dominant tenure in England. 65% of all 25 million households in 24-25 were owner occupier, a rate that's been pretty stable since 2019-2020. But this figure conceals the crucial internal reweighting. Historically, that peak of owner occupation was 2003, 71%, followed by a steady decline in the early 2010s, and then the bottom, 63% in 2013 to 14. We've recovered to 65, as I've said, which is hiding that demographic-driven inversion of debt status. So this is about the composition. 65% might own, but 36% own outright, according to the 24-25 figures, compared to mortgagors, people who own their property with a mortgage, who account for 29%. So it's a big gap. Far more than half of the owners own without a mortgage now. Disproportionate growth of outright ownership is a decade-long phenomenon. In 2013 to 14, the proportion of outright owners, 33%, was only just ahead of the mortgagors, 31%. So the gap's now widened to 7 points from 2, sort of reversing the reliance on traditional on leverage that we've seen in earlier cycles of this housing market. So substantial realignment in ownership structure, at least partially attributable to the fact that people are getting older. Now everybody gets older every day, of course, but more people are getting older because of the baby boomer stomach that appears in the figures, in the demographic figures in terms of the population of the UK. Lots more of them had their houses for lots of time and have managed to pay their mortgages off and are hanging around, sitting there in those unencumbered properties, right? So in the English Housing Survey, they talk about HRPs, household reference persons. This is the person deemed to be the economic head of the household. They earn the most money. Right? That's how it is. So overwhelming number of outright owners concentrated in the upper age bands. So 62% of outright owner households contained a household reference person 65 or above. So that's not necessarily the head of the household, but actually someone in the household they could refer to. So 65 or over across all tenures. If you're 65 or more, 79% chance you're an owner occupier, and within that group 74% are outright owners. So only 5% are sitting with mortgages. Now you might say, well, of course they're 65, so why would they still have a mortgage? But then we'll get onto that later. But if the average age now is 34 and everybody's taking a 30-year mortgage, anyone where anything goes wrong, there's no room for anything to go wrong there at all, is there? Because you're 64 by default on the average case. So this isn't something that's going to persist over time, I don't think. But it demonstrates that profound correlation between advanced age and asset consolidation, contrasting sharply with mortgagors who are typically concentrated in the middle age bands, and private renters, the majority of whom have HRPs aged 25 to 54 as it goes these days. So, regional analysis further highlights the maturity and equity divergence. London exhibited a significantly lower outright rate. 23% of households are outright owners compared to 38% in the rest of England. So that 36% actually comes from 23% London, 38% rest of England. Nearly 2 in 5 in England are owner-occupied outright household, no debt at all. Potentially correlated with the lower median age in London, 35, as reported by the census in 2021. So partially something to do with, as I say, age is the best predictor of whether you own your house outright or not, or whether you even own a house at all. Specific regions such as the northeast have had a bit of an acute transformation since in the last 10 years. Outright ownership surging from 30% to 39%. Mortgagor proportion concomitantly decreased from 31% down to 25%. So a big divergence. Up 9 in the outright ownership, down 6 in the mortgaged ownership. Significantly different. But geographical heterogeneity underscores that the path to equity maturity is regionally nuanced, but nationally defined by ageing demographics. But beyond demographics, the increasing financial stratification between outright owners and mortgagors is stark. How do you look at financial resilience in a household? Well, you look at their savings, right? It's robust for outright owners. 83% reported savings in 2024 to 25 of significance, which is a big increase from 75% reporting savings in the pre-pandemic period. But this is what happens. You have a pandemic, people get scared, they're more aware of really bad things that might happen. There's all sorts of concerns at the moment, especially if you're an outright owner and you are of advanced years. You might need private healthcare, things like that. So this particular cohort have been shielded of the effect of the higher interest rates, this interest rate normalisation that I keep talking about, because they haven't got any debt, right? And in fact, they benefit from it because they've got savings and they haven't got debt. So they're better off, they can absorb those cost of living increases better than the other groups. Their electricity bill still goes up the same as everybody else's, but their mortgage doesn't, ultimately, because they don't have one. So people who've got mortgages have still got strong savings rates, 73% up from 60% pre-pandemic. So again, they're making even more relative reason to save, but they're directly exposed to interest rate volatility. And that necessitates examining the financing structure for new entrants to the housing market as new owner-occupiers, also known as first-time buyers, right? So the structural deformation here involves necessary elongation of debt repayment schedules for those first-time buyers. So we were at 32 average age for a first-time buyer in 2019 to 20, up to 35 in London. The average age now around England is 34. So up a couple of years, statistically significant. But the most critical metric indicating structural affordability pressure is the mortgage term length. So 62% of first-time buyers have now got a mortgage with a repayment period of 30 years or more. So that's a material increase. It was 47% 5 years ago. So that's up 1,500 basis points since then. But 15% as a percentage, 15 over 47, it's more like a third. A third more first-time buyers are using 30-plus year mortgages. So the 30-year term is now the norm. It's not a flexible option anymore. It's the de facto market standard for market entry. Now, the financial engineering side reflects the higher barriers to entry. Further evidenced by the concentration of first-time buyers, and there'll be no surprise here, in the highest two income quintiles. 34% are in quintile 4 and 30% are in quintile 5. So 64% of buyers are in the top 40% of income brackets, which isn't a particular surprise. I always talk about the unfortunate truth that ultimately the average private renting household in the UK has got a household income around 34k. The average first-time buyer household has got a household income of around 60k. And you can't fix that. You can tweak it. You can do a bit in terms of fewer regressive taxes, a little bit of redistribution and all the rest of it. But ultimately, if you don't earn enough, you're not going to buy a property. It doesn't have to be like that, of course, because you can save money, move to a particularly cheap area, all the rest of it. It's not like you can't do anything about it, but these are figures across millions and millions, tens of millions of households, remember. So this is the average, the danger of the average. So market access ultimately to first-time buyers are restricted somewhat to households who earn more money. No massive surprise there, really, is there, from the survey? And the average deposit for a recent first-time buyer was still substantial. The average deposit, £78,131. So the average person is still putting down about 20% or even more of the average house price in the UK, even though there are all these 5% mortgages and even 0% deposit mortgages and things like that. But it shows you how much capital needs to be accumulated to be in this market in the real world. In synthesis, the English Housing Survey data also establishes these two parallel realities within owner occupation. A robust ageing cohort of outright owners benefiting from decades of appreciation and debt maturity, high financial security, 83% with savings, dominating the ownership structure, 36% of households. Pipeline of new mortgagors characterised by older first-time buyers systematically extending their debt horizon, with 62% committing to that 30-plus year mortgage when they go in. Now, it's not all as bad news as all of that, because bits not in the survey, but things that you need to know is a very large proportion, over 50%, of first-time buyers actually overpay on their mortgage. So they're not necessarily going to see that 30-year term or more out because they're overpaying, and they see these clever bits of trickery from the Martin Lewises and otherwise of the world, where you can clip 4, 5, 6, 7 years off your mortgage if you can afford to overpay. And remember one thing, you're scored for affordability at the moment. We saw the Bank of England Money and Credit Report. They're coming out, average rate about 4.2%. Average rate for a first-time buyer would be a little bit higher than that, because normally they've got lower deposit, slightly bigger risk, even if we said 4.5%. But risk-wise, in terms of stress testing, they've been stress tested at probably 6.5% or so, something like that. So they can afford payments at 6.5%, not 4.5%. If they make the payments that the credit scoring has told them they can afford to make, that will be an overpayment in the mortgages, right? So I hope that makes sense. And the market's adapted to these high prices by lengthening the duration of that debt. So what are you saying? You're saying early career affordability is being swapped for protracted exposure to financial liability. If you mathematically modelled this out, what you would see is much more money being paid over time. Now, that wouldn't necessarily be completely fair, because that would solely be nominal amounts of money. And if you've got to pay money in 35 years' time, you'd rather do that than pay it in 25 years' time, because inflation will take its toll between year 25 and year 35. But the point is still valid, ultimately. The bank, the lenders, the underlying lenders, they get the compound interest premium for people taking out loans for longer periods of time. So, pay back more, take it out for longer. That's been the solution the market has basically imposed on itself, and expectations are now adjusted by the first-time buyers, because they are the most important participants in the marketplace. As I say, without the first-time buyers, the system doesn't work. We work bottom-up, we don't work top-down. So this is the English housing market, where your principal is due plus £112 a week on average. So what does that mean? So for the investor, ultimately, that's what we're thinking about in this section. This is not a lament on intergenerational fairness, although a lot of people do fall into one camp or the other on that argument. And it's a nuanced argument. It's nowhere near as clear as some people make it out to be. This has become endemic. I'm calling it temporal stretching, temporal as in time. So there is temporal stretching to 30, 35 and even 40-year mortgage terms now. So a large segment of working age aspiring homeowners will remain in the rental sector for longer. If the average first-time buyer goes from 32 to 34, it stands to reason the average person is staying in the rental sector for 2 years longer, apart from anything else. So it's an involuntary demand profile ultimately, but it's the essential engine that drives the observed velocity and quantum of housing cost inflation across mortgagor and rental segments. Now, the biggest driver in putting rents up over the last few years ultimately has been inflation, and particularly the change in the price of the interest rate. But 40+% of landlords do not have a mortgage to pay, just like 36% of all households do not have a mortgage to pay. 40% of all rental stock, or 40% or more, does not have a mortgage against it. So when the interest rates go up, now you could still argue those landlords do still need to put their rents up, right? Because otherwise the alternative landscape has savings, no effort, no risk, no renters' rights, no all the rest of it. Well, that reward has gone up from basically nothing in 2021 to 4%-ish, via it being sort of 5 or 6% for a short while in 2022, 2023. So ultimately that's what comes down to. That ultimately comes down to you've got people in rentals that don't really necessarily want to be there, but ultimately you've also got people who own properties, rental properties they wouldn't really own otherwise. If they didn't already own it, they wouldn't buy it again, is what I'm saying. So the data has been provided. It's empirical validation of cost inflation. When the market puts rent up, then the savvy landlord puts their rents up anyway. Let's not pretend that doesn't happen. But the cost of shelter, whether you own it or you rent it, has escalated at a substantial and non-linear rate, particularly within high demand urban centres. What blame should the government take here for increasing the cost of rental unit delivery and the risk by quite so much? Well, I would argue a significant amount, because investments are always about cost, effort, and risk. But the government chooses not to see that and says it knows best about renters' rights and all the rest of it. So the cost of capital arbitrage and rising nominal yields, well, the most immediate and material impact of the current macroeconomic environment is the demonstrable rise in debt service costs for owner-occupiers, which provides a comparative reference point for the cost of capital required by highly leveraged buy-to-let investors. So mean mortgage payments, £242 now weekly, nationally, the average. So a little bit over £1,000 a month. Crucially, in London, the average mortgage payment has vaulted to £375 in 2024-25. Remember, these are all after tax as well, so over £1,500 a month, which is an increase of £112 since the pre-pandemic period. Not bad, really, only up by £112 on 1,500. I'd have thought it was much larger, but of course, people have been paying down mortgages quite aggressively, and some have had the advantage of remaining on lower interest rates. Interest rates were a little bit higher in 2019-20 before the pandemic, went down significantly 2021, and have bounced back up. So one of the things we'll see in 2026 is people falling off their 5-year mortgages they took out in 2021 at the nut low, the ultimate low point of cost of debt in the marketplace. But outside the capital, the mean weekly mortgage payment rose significantly by about £50 a week. So £112 more a week is obviously significant. You're paying what, £450, about £475, £480 extra a month, an extra £500 a month on your 1,500. So you're having to find about 33% more money. £50 on 170, similar sort of ratio really, 170 to 220, but it just shows you 220 average outside of London, 375 average inside London weekly mortgage payment. So this really signals two things to the investor. The barrier to entry financially for ownership is arguably higher than ever, which puts more people stuck in the private rental sector. Now, ultimately, there's been a lack of significant change. I was one who expected the 19% of households, which is the figure we've been using for years. We have been as high as 20%, or if you went back to 1900, we'd be as high as 90% were in rentals, but 20% households down to 19. I thought we'd break 18 at some point. And what that is probably saying is that whilst we know there are lots of landlords disposing, and all the figures say that there are lots of landlords disposing, but ultimately that stock must be being bought by other landlords. Now, put it into context, we're talking about 4.7 million rental units in England of 25 million households. So a 1% change requires 250,000 households to change tenure. So we could lose 125,000 rental units and it'd still be within the 19% bracket quite comfortably, depending on where we started. We really need the decimal points on this stuff in the English Housing Survey, but I would say that as a man who can wear a shirt like this and is obsessed with numbers, of course. But buy-to-let investors have got to underwrite debt at a higher yield in order to make rentals viable, right? Because if you've got to pay, and in the PRS, 5.5% on your debt, if you're lucky, what sort of yield do you need for debt service coverage? You need nearly 7%. If you're looking to make a profit, or at least insulate yourselves from non-payers of rent, boilers, roofs, all the rest of that sort of stuff, 7% is only going to be a break-even sort of number. So you're looking at more like 7.5, 8, 8.5, depending on what your cost of delivery is like, depending on how much effort you're willing to put in yourself, of course. So mean private weekly rent across England, comparing it to those mortgage figures, £250 a week. That's up from £201 in 2019-20. So you can see there, that's up about 25%. Mortgage figures, we said, were up about 30 to 33%. So mortgages have become more expensive than rent. Actually, rent has still got a little way to catch up, but this was only to March 2025, and rent still has been catching up in the month since this was published, whereas interest rates have been coming a little bit, tiny bit downwards, as I said before. So the divergence creates an explicit mandate for geographical risk weighting. London average rent £393 a week, so more than a mortgage. Although I hate this comparison of rent and mortgage, as I've said many times before, because if you own it, you need to pay for your own insurance, you need to pay for your own maintenance, you need to pay for your own compliance if you decide to do it or not, because you have the freedom to do that, because you own the property, of course, apart from anything else. There are many more out-of-pocket things that you need to pay for, and you usually have got to pay for improvements. You want improvements because it's your home, so you spend quite a lot more. Whereas it's £207 a week average rent across the rest of England outside of London. So we're talking there 825, about nearly 900 quid a month average rest of England rent outside of London. So that velocity is not confined there to the margin, because the average private rent weekly increased both nationally compared to the prior year 23-24 and is significantly up on the pre-pandemic period, but not up as much as the average mortgage payment, as I've said. So stronger nominal growth yields are needed, ultimately higher cost bases, higher everything, right? Higher investor financing, but higher cost of everything, more compliance to do, more rent agents need to potentially charge more because of what's going on in Renters' Rights Act, and they need more training. There are more bits and bobs for them to do in terms of defending landlords against future claims in a litigious society that we live in, right? This is exactly how I said the market would have to react to interest rate normalisation. Market rents would have to come up because they'd have to substantially improve yields. There's only two ways in which yields can improve, right? And both of them require rents to be going up or down less quickly, more quickly than capital growth. So capital growth goes down, rent stays the same, that increases the yield. Capital growth stays flat, which is where we've been largely speaking for about 3 years now, roughly. That's a very broad statement, and regionally that doesn't necessarily apply, but in England it certainly seems roughly like it applies. But if rents go up and capital values stay the same, yields still improve. But investors need improved yields in order to buy property. So affordability is always the kicker of this argument, and you do need to watch it. If people can't afford it, they can't rent it. It doesn't matter what you need as an investor for a deal to stack up. If the tenants can't afford it, they can't rent it. So that's where market fails. And I'm looking at London and the South East to see how inevitable market failure is going to manifest itself in the coming years, because that's where the affordability headrooms are pushed the hardest. And with all this fiscal drag and these frozen thresholds, people down there who are more likely to be renting and earning over 50 grand a year are pushed into the higher rate threshold, and they're losing 42% of all their pay rises every year. So even if they get a nice 4% pay rise, they're only going to see 0.58 times 4. So what's that? 2.25%? In real terms, pay rise wise. It depends, because their base level doesn't necessarily come tax free, so it's not quite the right maths, but bear with me. So this is compounded, this situation, by the structural income profile disparity that I've already talked about, right? Remember, mortgagors, 40% of owner occupiers with a mortgage are in the top 20% of earners, right? On the other hand, private renters, who are much more evenly distributed across income quintiles, actually, because you get a lot of people renting on good salaries, but they're in London, for example. But they include substantial numbers of working households. So 76% of household reference persons in the private sector work full or part-time. The other way of looking at that is 24% don't. And it's a fair miracle they're in the private rental sector, to be honest. But of course, some people go in and out of jobs. This is a snapshot in time. It's not always the case. There's lots and lots of people have lost their job this year. Quite a lot of people for the first time, because it's the first tough job market they've been through after those employers' national insurance rises that surprised us all in the budget last year. So investor benefits from the fact that those with the highest earning power are frequently pushed into the mortgage or tenure. They buy properties, whereas the private rental sector retains the people who are under financial pressure to an extent, but they're working and they sustain their rent payments, particularly when compared against the social rental sector, where 50% of the household reference persons are in the lowest income quintile. It's difficult with figures like that to know what's right, though, isn't it? Because how many of the lowest income quintile should be in social housing? You know, a very large amount. They're obviously 2.5 times overrepresented there, but you would expect that because the border, the brackets on social housing are about household income. So you would expect that. Is that enough? Too much? Difficult to say. Leave me a comment if you've got a view on that. What about the risk-reward calculus then? Affordability and exposure to arrears. So, nominal increase in rental receipts sounds good, looks great from a distance, but what about the operational risk? What about tenant vulnerability? What about exposure to arrears? English Housing Survey sees private renters spending 34% of their household income on rent payments, when you include housing support in their income. If you don't include the housing support that they get in the private rental sector, they're spending 39% of their income. But of course, they do get their housing support. But this is a lot more than the 19% of household income that's spent by mortgagors on their payments. As I say, the big reason for that is the mortgagors are earning nearly twice what the average private renter is earning, of course. So that's the majority of the reason why that disparity is there, but still doesn't explain all of that disparity, does it? So, 60k versus 35, very, very rarely spoken of. Biggest indicator of all. You don't really need to know someone's age necessarily. What is their income? Do they rent or buy? You'll be able to tell it significantly. Of course, when people are retired, sometimes their income goes down. More than often, they own a property outright, so they haven't got the need for such a big income because they haven't got debt to service apart from anything else. But this high proportion of income allocation is directly correlated with a palpable increase in tenant financial strain. 32% of private renters reported finding it either difficult or very difficult to pay their rent in 2024 to 25. I suspect you'll hear that number time and again now this survey has been released. That metric's really critical though for investor risk modelling, because pre-pandemic it was 27% that was struggling. So a significant 500 basis point difference. 25% more people nearly reporting that they're finding it difficult to pay their rent. How long can rents continue to move along as they have been? Although all the anecdotal evidence I'm hearing and what I'm seeing in my own portfolio is rent rises have calmed down massively, and you need to be much more realistic in order to let stock these days. So the investor has to navigate a market where the drive for high yields clashes directly with tenant capacity limits. Overall, private renter arrears risk has shown some historical fluctuation, with 5% of private renters reporting current or previous arrears in the last 12 months of 24-25. The rising difficulty in payment means a lag effect on future arrears, probably, which means income projections need to be cautious. Investors might seek to take out some of the risk in the renters' rights bill by de-risking by taking insurance on tenant affordability and all the rest on tenant rents and things like that. So rent guarantee insurance might become more popular, even though there isn't a lot of margin to pay for this stuff these days. But as I say, 40% are unencumbered, so never forget that, folks. So investors have got to account for prevalence of vacant dwellings in the PRS. So in 2024, we had 11% vacancy rate in the private rental sector, with 8% of dwellings classified as awaiting another tenant or owner. That's such a frustrating point in a survey like this. Do they not realise how seismically different waiting for another tenant and waiting for another owner, as in they're on the market for sale, right? Huge difference between those two. We really could see with that 8% being broken down. I cannot believe the people who run this survey cannot see that. So rant of the day is absolutely on the English Housing Survey and not asking the right questions. I hate doing things by survey anyway rather than measuring actual data, but this is absolutely critical. So this vacancy rate in the owner-occupied sector is 3%. So that tells you the sort of level of turnover for people who are looking to sell their house. And obviously most people who are looking to sell have stayed within their house, apart from that, this is people who've moved abroad. This is people who perhaps come together as two households have become one, for example, things like that. So only 3%. But people need to maintain pretty robust capital reserves to cover debt service during these void periods. If they were owner-occupiers waiting for sale, you would think they'd still be living there, as I say. But really, this survey needs to make that very important distinction. I don't know what the Ministry of Housing, Communities and Local Government really wants to draw out of this very rich data set, but clearly they don't have anyone snagging it for them. But anyway, the English Housing Survey data package shows this highly stratified investment proposition. Underlying macro conditions have meant temporal stretching for first-time buyers and have inflated those owner-occupied costs up to £112 a week in London, as I said, a powerful structural uplift to nominal rents, favourable yield opportunities in a high inflation environment. Great for property investors who use debt, ultimately. But you have to counterbalance this with a demonstrably fragile tenant base, where over a third of private renters are reporting financial difficulty in meeting their obligations. So the sophisticated investor understands the current English housing market is a high beta environment. High potential reward derived from sustained inelastic demand, coupled with operational risk, necessitating superior tenant selection, active asset management, and rigorous accounting for non-payment and vacancy rates to convert rising yields into sustainable risk-adjusted returns. The other conclusion that can't be avoided is that the great exodus of landlords, much publicised by the rampers and the clickbaiters, is instead landlords selling to other landlords, certainly the way it's played out thus far. We have still not even moved from the PRS being 19% to 18%, although I did mention that peak at 20%. So, your home might be fine, but you are less happy. Here's the conclusion of the deep dive. The pandemic legacy creating two-tier resilience. Right, so this isn't all about just numbers. It's not a compendium of dwelling types and debt ratios. It's a clinical post-mortem of the psychological and societal scar tissue that's been left on our society by the COVID-19 pandemic, now overlaid by acute cost of living pressures. 4 years post-onset, the EHS confirms we weren't back to normal. We're in a structurally impaired landscape where the pandemic's legacy dictates financial resilience and, more depressingly, the collective capacity for contentment. So the data's clear, the pandemic did not act as this great leveller. It was a selective accelerant of existing inequalities, forging this two-tier system of household resilience. Asset-rich, debt-free, outright owners laughing ever more than they ever have been. The pandemic and the subsequent fiscal and monetary responses appear to have structurally enhanced their financial position. Proportion of households with savings is still higher than it was before the COVID-19 pandemic. Starkest among outright owners, where 83% reported having savings in 24-25, which is up significantly from that 75% that I mentioned before. But that's the cohort who was shielded from the cost of rising interest rates. And in fact, as I said, did a bit better because their savings that were in the bank, that were liquid, instead of getting 0% in the building society, started getting 4% again, apart from anything else. Compare that to the rental sector. You know, their savings presence is better, actually. 52% report having savings compared to 40% before the pandemic. And social renters, 27% of them report having meaningful savings, up from 20%. The core issue is still financial fragility. Fragility manifests itself as heightened financial exposure to risk, particularly when juxtaposed against the backdrop of massive rent inflation noted in the middle section of the deep dive. Disparity of financial resilience is one of the most corrosive legacies of the pandemic. Certain segments are more financially comfortable, able to absorb shocks, whilst a smaller but substantial proportion of households struggle and are increasingly exposed to risk. But here's where the existential gut punch comes in from the survey. Money, or lack thereof, is not the only lingering trauma. The data illustrates a widespread cross-tenure decline in subjective well-being and accommodation satisfaction, a collective structural unhappiness that persists despite, in some cases, improved savings levels. The report states explicitly that average well-being levels remain lower than they were pre-pandemic. Compared 24-25 to 19-20, fewer households reported satisfactory life, so 7.5 versus 7.7 out of 10, and anxiety has demonstrably risen, 2.9 versus 2.7, reporting significant anxiety. Now, people are acutely aware of just how much rent has gone up. On that basis, you pay more, you expect more. So if you pay more and get the same, people don't have a deep understanding of inflation. 90% of the population don't. They, by definition, will be less happy, right? So the pandemic forced a fundamental, unwelcome re-evaluation of our relationship with our primary dwelling. Suddenly it needed to be an office, a school, a gym, and a constant refuge. And what was the outcome? Households now report lower than usual levels of satisfaction with their accommodation. Satisfaction down across all tenures. Even owner-occupiers who have huge levels of satisfaction, 94%, it's still down, marginally, but statistically significant, from 95% before the pandemic. Private renters down from 83 to 81. Social renters down from 78 to 75. The dwelling, supposed to be our sanctuary, the Englishman's home is his castle and all the rest of it, instead a source of pervasive and low-level discontent. But the most tragic legacy is the stratification of loneliness and personal well-being. The social rented sector has been profoundly damaged. Social renters consistently report the lowest mean scores across the ONS well-being measures, lowest life satisfaction, lowest happiness, highest anxiety. 6.8 on life satisfaction, 6.9 on happiness, and 3.5 on the anxiety side of things, with a disproportionate sense of social isolation. Those in the social rented sector were the most likely to report feeling lonely, often or always, at 13%. I mean, that's a huge number, isn't it? The pandemic exposed and cemented the vulnerability of this sector, which also saw the largest increase in households containing someone with a long-term illness or disability, surging from 54% pre-pandemic to 61% in 24-25. But that stat's an absolute showstopper. COVID caused some of this, of course, but the reassessment of disability benefits, personal independence payments and the likes, already controversial, already having led to rebellion in the House of Commons, but due a second bite of the cherry on the slate in Parliament is surely needed. This figure is not comparable in other developed nations. Some action is needed and more deeper dives and educational pieces are critical. But But this is the reality laid bare by the English Housing Survey. A society cleaved between those who have capital reserves and equity, financially resilient outright owners, and those who are struggling to pay high rents, those increasingly anxious renters. The economic stress and the enforced proximity of lockdown have translated into chronic, lower aggregate well-being and higher rates of disability and illness across the board. We may have bounced back on some economic metrics, but psychologically and structurally we're running on lower octane fuel, less happy, more anxious, more discontented with the place we are forced to spend most of our time. The solution, of course, is the perennial struggle against complexity and apathy. We look at reports like this full of dense data, structural realities, and the only logical conclusion is that the government is forced to keep tweaking the system rather than doing something proper. The pandemic didn't break the housing market, it just finished hardening the existing fault lines, reminding us that despite all the data and the analysis, the core problem remains. There's no creative funding model to get around the requirement for appropriate returns on capital investment. So, here's the bit that's been missing from too many supplements recently. So what? What should we do about the contents of this newsletter? Well, here we go. UK property investors should consider a high beta, risk-adjusted strategy in response to the current market structure as detailed in the English Housing Survey. So they need increasing nominal yields and they need to balance that against heightened operational risk due to the incoming Renters' Rights Act. So investors need to rigorously measure and calculate nominal gross yields as the market is successfully transmitting higher capital and financing costs onto the consumer base through rising rents. Mean weekly private rents have increased substantially, particularly in London, providing higher yields for debt service cover, but are they high enough? If not, consider disposal of those assets, or at least repurposing those assets to HMO or to provider/social housing. Given the significant financial strain on tenants, 32% reporting difficulty paying rent, investors must prioritise superior tenant selection and active asset management to mitigate risk. Due to the 11% vacancy rate in the private rental sector, investors should also maintain robust capital reserves to cover debt service during void periods, ensuring rising nominal yields translate into sustainable realised cash flow. Just this week, I've heard many stories from landlords in the south of England in a WhatsApp group that I'm in, group number 734, of course, asking rents are down 5 to 7.5%. I suspect there's been some overshoot. Rents went up like a rocket, as certainly did, and on rent review we're finding more and more rents that need to remain the same or cannot justify an increase year on year. Investors need to strategise geographically by recognising the clear north-south divide in price performance, and while London prices are falling, regional markets like Northern Ireland are showing strong annual growth. If you're in London, either sell and repurpose the capital, or work towards paying down debt, because you can't afford anything that looks like an LTV strategy that's above 30 to 50% depending on your yields. And when you're selling, vendors need to be aware of the notable 29.3% gap between those seller expectations and buyer reality. As I say, I think that's an anomaly this week. So that gap was under 7%, as I mentioned, just a week before. So keep an eye on this gap, though, because week on week I will be keeping my eye on it. And in the real world, cheap stock's selling well, and every mini mansion that hasn't been caught by the tax, or not yet caught by the tax, should I say, that was thinking of selling has now been listing industriously after this temporary certainty delivered in the budget. So in areas where affordability is improving for homeowners, investors should consider selling to first-time buyers, a much more favourable prospect for an exit than an investor. And finally, investors need to remain confident in the structural inelastic demand for the PRS, which is ultimately underpinned by the increasing necessity for first-time buyers to take out these longer 30-year mortgages. Aspiring homeowners are trapped in the rental market for extended periods, and the market structure confirms that landlords generally are obviously selling to other landlords rather than that unit leaving the sector in its entirety. And this is helpful in many ways because rents at affordability limits in certain regions of the UK are much closer to their ceilings than they were 5 years ago in other regions. A shortage of supply wouldn't help anybody. So the average renter is now staying 4.7 years in the PRS, so the void can and should be avoided. This is a key figure in your projections. Compare it to an HMO turnover rate, for example. Not inevitable in every HMO, it depends on your tenant type, but it's a critical metric that's overlooked far too often by investors in my experience. So as I draw this week to a close, our next property business workshop is filling up, and as we turn our eyes to 2026, tickets are available. We start the year with a bang, discussing strategic planning and how to make the most out of the next 12 months, with some of our own methods and takes on productivity and time management, alongside systems and processes. The other half of the workshop is about the most common pain point in SME property businesses: accounts, bookkeeping, and group accounting. This is about measuring the performance of your assets, not how to use Xero, but how to make the most out of financial information. What should you be seeing monthly, quarterly, and annually? How should you interpret it properly? And how should you use it strategically to grow your business safely but quickly? Super early bird tickets are still available for another couple of weeks. They've got a genuine 20% discount off the face value. And as always, we have real life case studies about our own experiences. And we close with our no holds barred Q&A. Have you got anything individual to consider? Well, get yourselves a VIP ticket and join us for dinner. There's a handful left. It's a smaller setting with an opportunity to discuss any specific roadblocks or issues in your property business at the moment. It's the best way to get a substantial conversation with myself, Rod, and other experienced property business people. Join us on Thursday, the 22nd of January 2026 in central London. Link in the notes. It's also at tinyurl.com/PBWNINE. So please remember, keep calm, always listen to the supplement and carry on. There will be opportunities abound this year and towards 2030 and beyond. The landscape's set for a surefire bull run. It will be slowish and it will take a little while longer to get off the ground, and the amount of stock around is still keeping things a bit suppressed at the moment. But as the market's continuing to improve slowly and the rates are coming down slowly, it's a case of here we go, in my opinion. Thanks for tuning in.